Hello again, this is Doc C here for Cochran Consulting. We are a mergers and acquisitions firm that specializes in our E4 system, E1 entering, E2 evaluating, E3 enhancing, and E4 exiting business ownership. We do more than just sell or acquire businesses. We actually help build businesses. And today's topic is on equity ratios. We've been doing a series of ratios, some indicators that we use in evaluating a business to see where they're at. And I'm showing these videos to kind of explain that process to business owners. Before we get started, if you have any questions, or you'd like to send me an email or us an email, go ahead and email us at cochranconsulting@yahoo.com, or you can email me personally at curtis@ccochranconsulting.com. Okay, let's get started. Oh, before we do, let me just say one more announcement here, and that is if you're really thinking about selling your business, if you're really thinking about that, you want to give yourself at least 3 to 5 years, okay, or at least contact us so we can explain to you why you need that time to prepare your business to sell. We'll talk more about that at another time. All right, let's get started. Let me go ahead and share you my screen, and there we are. Here. Okay. Hopefully you can see a little Excel spreadsheet. And again, if you are a first-time viewer of our Excel spreadsheets, if you would like a copy, send me an email. I'd be happy to send this over to you. So today's topic is equity ratios, or equity ratio. It's pretty straightforward, nothing really exciting about it. The equity ratio is opposite of debt ratio. It is the portion of the company's assets financed by, of course, stockholders. And of course, you divide your total equity by your total assets, and we come up with a simple percentage. Now, this is an example of a company that we actually are working with. The years actually 2019 through 2022, 19, 20, 21. Yeah, that'd be correct. And I have yet to even change that, but that's all right. Couple of things to consider about this, and I've written this down so we could go through it. It is usually easier to acquire assets through debt than to acquire them through equity. There are certain obvious considerations. For example, you might need to acquire investment capital from many investors, whereas you might be able to borrow the required funds from just one creditor. Less obvious is the issue of priority. Now, by law, if a firm ceases its operations, its creditors have the first claim on the assets to repay the borrowed funds. Therefore, an investor's risk is somewhat higher than that of a creditor. And the effect is that stockholders tend to demand a greater return on their investment than creditors does on its loan. The stockholders' demand for a return can take the form of a dividend, requirements or return on its assets, each of which tend to increase the market value of their stock. And the last thing there is no always in financial planning. Of course, that's a no-brainer, because investors usually require a higher return on their investment than do creditors. It might seem that debt is the preferred method of raising funds to acquire assets. Potential creditors, though, look at ratios such as return on assets. We've done a video on that. And of course, this debt ratio as well. A high debt ratio, or conversely, a low equity ratio, means that the existing creditors have supplied a large portion of the company's assets, and that there is relatively little stockholders' equity to help absorb the risk. So this is, most small businesses really kind of don't look at this equity and total equity and assets. It's a good indicator when it comes to growing your business, whether through debt or equity, something to take into consideration. All right, so that was kind of not too exciting ratio, very, very important ratio, as all of them were. But again, if you'd like this, please send me an email. I'll send that over to you. Let me share with you a couple of things. I wanted to share with you our website. Let me get to that. There we go. So there's our website, and a couple of things. If you're a business owner, first of all, if you need funding, if you click on this need funding tab, we have two sources right here, pretty good sources. Although you could actually get a lower interest rate through possibly SBA and a couple other things. And we have SBA lenders too, but just let us know. If you want to increase the value of your business, click on this tab. Okay, so if you come down here, want to increase the value of your company, we can help you increase the value up to 71% in 12 months. If you are interested in that, that's what we do. You click on that and fill this out. It'll shoot us an email and we will contact you and help you get started today. The other thing I wanted to share with you, our books right here. This is a moneymaker right here. The Semantics of Mathematics and Business. Don't let the title fool you. Click on that. It'll be the best $20 that you'll ever spend, because that is our company and this is our system right in this book right here. Let's see. Oh, one other thing. This is a free success roadmap. If you click on that, click on either one of these diagrams, click there, it'll take you to this page, fill this out. And again, we're not going to contact you. When you fill out this information, we're not going to hassle you. Look, we're not salespeople. We help build companies. We help people exit companies with money. Okay, that's what we do. So we're not selling anything. So, but once you fill this out, we'll send you a free PDF. Again, it's a 10-page roadmap of how our system works. Okay, that's it. And if you want to contact us, hit contact and fill this out. We can even have a free consultation. We can talk about whatever you'd like to talk about dealing with business. Well, there you have it. Debt ratio. The next June month, we're going to be talking about all kinds of topics, because we're taking them from you, the viewers. You guys are sending us emails and finding out and asking questions about how to build companies and how to raise capital and how to actually exit in style. So thank you so much for listening. Please feel free to email us at any time, cochranconsulting@yahoo.com or curtis@ccochranconsulting.com. Doc, see you out. Take care. Bye-bye.